What's up investors, Snir is here. Microsoft recently acquired Activision Blizzard for $95 per share, yet their stock right now is traded for $79 per share. It raises a valid question, but isn't it just free money? If I buy Activision for $79, I'm guaranteed to get $95 from Microsoft. So essentially I get a guarantee for money. Why shouldn't I buy this opportunity? This whole story goes to a field called risk arbitrage, and I want to talk about it. What are the risks and why is the price relatively low to the $95 that Microsoft said to pay for Activision, and why in general you should avoid this kind of investments. So let's go into it. Before we begin, if you are new here, my name is Nir and I'm a value investor. I'm on a journey to find value opportunities and building a very highly concentrated value portfolio. I have a newsletter in which I write deep dives into many companies. For example, Arbitrage is one deep dive. So if you're interested in my journey for value investment and or my deep analysis, you can subscribe to the channel or go to the link below to the newsletter and subscribe to it. And with that said, let's continue. So when we talk about opportunities in the mergers and acquisitions world, which is this specific world of Microsoft buying Activision, there are two main risks we need to be aware of. The first is the time risk, because Microsoft announced they will purchase Activision, but when will this acquisition will actually take effect? And up to this point, will your money just be locked up? And the second risk is obviously that the deal will not go through at all, and it happens a lot. Let's begin with the time risk. In their announcement, Microsoft acquire Activision Blizzard. They said here, right at the bottom, that they expect the deal is expected to close in fiscal year 2023. That means essentially that it can take up to 2 years from now, and even then, it's not obvious that it will happen within this time frame. That's just expectations. It might take longer. So if we look at the opportunity right now, let's look at Activision, which is now $79, and Microsoft announced that they will buy the stocks for $95 a share. Here it is. So the arbitrage here is actually 20%. So if you buy right now at $79, you will get 20% gains on your investment. But if we talk about 2 years, that becomes a bit shady, because in 2 years, let's spread $20 to 2 years, it's about 10%, a bit less because of compounding, but it's good enough for our case. So we talk about 10% gain per year, which is unsure, which is right now, if we look at the performance of S&P 500 recently, we see last year 26%, a year before that 16%, before that 28%. 2018 was a bad year, but just 6%. Focus on that number. Of course, big crashes like 2008 or the .com, but let's look at the typical performance. We see here 9%, 19%. We have here 29%. So the point is that if we take 10% per year, it's not actually a very good performance relative to what you can do in the market. And you take all this risk. So that's the effect of the time here. Now, the second obvious risk is that the deal will not go through at all. And deals fall through all the time. For example, we had recently NVIDIA with the acquisition of ARM. They just abandoned this $40 billion acquisition. And the first time this acquisition was announced was in September 2020. Here it is. And so it almost 2 years until they announced that the deal is falling through, which by this point was almost sure to happen. Still, 2 years later, and it falls through. So it's something we need to be aware of. And typically in the stock market, when a merger or acquisition is falling through, the stocks of the company that was acquired is usually going down to the price they were traded before, and typically even much below that, depends on the state of the company. Let's be rational and let's say that Activision Blizzard will go back to their price before the merger announcement, which was about $64. So if we look at that, it means 18% loss, potential loss in case that the acquisition will not go through. And so you find yourself in a position where you might lock up your money for more than a year, even 2 years, even longer than that. And not only that you locked your money, you lost in this time up to 18%, even more than that in case that the company will go and trade it below that, which might actually happen. These two risks paint an unbalanced picture. You either underperform the S&P 500 within the time frame, or you suffer massive losses. So it doesn't make sense unless you really know what you're doing to do that. And there are people that know what they are doing that do that. There are huge funds that do risk arbitrage for their livings. They have massive amount of analysts and resources and access to data that as individual investor you typically wouldn't have. And so if you will try to play the game of risk arbitrage against these kind of players, you will always lose, because they will know first if something good is about to happen. So they will typically leverage it with option calls to gain from this movement. And you will be too late to do that, obviously. And on the other side, if something bad will happen, they will be the first one to sell, leaving you holding the bag. So in this kind of game, unless you have the resources of a huge fund, you take even more risk in an already risky game. In general, this field of risk arbitrage typically calls for some type of leverage, because as I mentioned, if you wait for these 2 years without leverage, you will typically underperform the market. So if it will happen, and you're sure it will happen, you want to leverage your position to take more gains from this action and not underperform the market. Using the leverage, you will outperform the market. But this is even more risky. Even if you know what you're doing, it's risky. Let's look at a case. Let's look at what is called long-term capital management, which is a hedge fund that worked in the 90s and had huge gains. And we certainly had people that know what we are doing. The manager and the director of this hedge fund is a Nobel Prize winner in economics. So certainly certified for a very, very smart person in this field. And they did really great performance. They had 21% in the first year, 43% in the second year, and 41% in the third year. You get the picture. They were very rich, doing exactly that, risk arbitrage. They focused more on risk arbitrage in bonds, which is a bit different, but they also did mergers and acquisition. But in order to get this kind of performance, they were very highly leveraged. And the party sooner or later comes to an end when you do such a risky thing with so much amount of leverage. It doesn't matter if you are as smart as these people who are literally Nobel Prize winners in economics, and they had all the resources and all the smart analysts. They had billions of dollars, and yet, let's look here, due to one failure, this is the picture of their gains. You see, they rise up really, really fast, but then one mistake and it all went down really quickly because they were very highly leveraged to get a performance out of this risk arbitrage that typically gives you very little gains relatively. So they had to be very highly leveraged and they lost everything. So my points are, risk arbitrage isn't a game worth playing, especially not for individual investors and if you don't have massive resources. And even if you played it, you need to be highly leveraged to make it worthwhile. And this leverage makes a risky game even riskier. So you don't want to play this game. So that's it, guys. I hope you enjoyed this video. If you enjoyed it, subscribe to the channel and check the newsletter in the link below where I post their really deep dives and analysis for companies that I write. And I hope to see you here next time. Bye bye.